Welcome back to Talk Tickers. This is the show for experienced investors, where we stop reading the headlines and start stripping the earnings call down to the raw signal.
We cut through the PR spin to find out what's really moving the money.
I'm your host, and today we are turning our radar to the Caribbean. We're looking at OFG Bancorp, ticker OFG.
The financial holding company out of Puerto Rico.
Exactly. We're breaking down their fourth quarter 2025 results, which just dropped on January 22nd, 2026.
And if you were watching the tape that day, you know this was, let's just call it a fascinating session.
Fascinating is one word for it.
To put it mildly, this is a textbook case of headline beat, market retreat.
That is putting it mildly. Let's set the stage with the price action, because it really frames the whole mystery here. The stock opened the session around, $42.56?
Around there, yeah.
And by the time the closing bell rang, the door had just slammed shut at around $39.
That is an 8.36% drop in one day.
A brutal drop. And on significant volume, too. This wasn't some thinly traded stock getting pushed around.
Right. But here's the hook, and this is why we do the deep dive. Despite that carnage in the tape, if you just look at the raw data, the headline numbers were green. They beat consensus.
They did. So we've got this massive divergence to unpack. Why did capital flee a company that, on paper, just delivered a solid quarter?
I think it boils down to a few key things.
We're going to look at three of them. First, an efficiency ratio disappointment that really soured the mood. Then a huge movement of government money that completely changed the margin outlook for 2026.
And that was a big one. And
finally, a specific telecom loan that, let's just say, gave the credit hawks a reason to hit the sell button.
It's a complex picture. You have this surface-level success story, but it's masking some pretty big structural shifts that institutional money clearly did not like.
Okay, so let's start with the good news before we dissect the crash. The results, snapshot. What did the headline numbers actually look like?
Well, if you were just an algorithm reading the press release or, a casual investor glancing at a newsfeed, you would have bought the stock.
No question.
GAAP EPS diluted came in at $1.27. The street consensus was hovering around $1.15, maybe $1.16.
So that's a 10% beat. That is not a rounding error.
Not at all. That's a solid performance.
And the top line, did that hold up?
It did. Core revenues hit $185.4 million. The street was looking for about $184 million, so they edged that out by over $1 million.
And year over year?
Even better, EPS up 17% and core revenues up 2%.
Usually when a stock drops 8%, you expect to see the balance sheet shrinking, assets fleeing the building.
Not the case here at all. Total assets hit a record $12.5 billion. That's up over 8%.
Wow.
Loans are up 5.3% to $8.2 billion. Deposits up 5% to $9.9 billion. And their capital position is, it's rock solid. CET1 is 13.97%.
Okay, hold on. So we've got record assets, growing loans, growing deposits, and a double-digit earnings beat. And the market's response is to shave off nearly 9% of the value.
It feels emotional, doesn't it?
It does. What is the rational explanation?
It comes down to the difference between past performance and future profitability. The metric that really killed the mood was the efficiency ratio.
Oh, okay.
It landed at 56.7%. And management on the call, they explicitly said this was below expectations.
Okay, for anyone listening who just looks at PE ratios, let's unpack that.
Yeah.
Why is 56.7% a problem? Why does a percentage point here or there matter so much?
Think of it like the cost of doing business for a bank. It's how many cents it costs them to generate $1 of revenue. So at 56.7%, it's costing them almost 57 cents to make $1.
And you want that number as low as possible.
Exactly. Pushing toward 50% is the goal. In this kind of shifting rate environment, investors are looking for banks to tighten their belts.
Right.
So when management comes out and says, hey, we missed our own expectations on efficiency, the market hears a lack of discipline. It signals that as margins get squeezed, they might not be able to cut costs fast enough to protect that bottom line.
It calls the whole EPS beat into question, really, the quality of it.
It questions the durability of it, for sure.
I want to push on this a bit because 56% isn't, historically disastrous for a bank. Is it just the number or is it the context?
Oh, it's entirely the context. If your revenues are skyrocketing, you can get away with being a little inefficient. But as we're about to get into, their revenue engine, the net interest margin, is under threat.
Right.
So when your top line is getting squeezed, your expenses need to be pristine. And right now, they're not.
Speaking of that revenue squeeze, let's pivot to the biggest narrative shifter on the call. The net interest margin, or NIM. This feels like where the real anxiety is coming from.
Absolutely. The NIN is the engine room of the bank. It's the difference between what they pay for deposits and what they charge for loans. And, well, the engine is sputtering a little bit.
So what were the numbers?
In Q4, the NIM was 5.12%. For the full year, FY25, it was 5.27%. And those are healthy numbers historically.
But markets price the future, not the past.
Exactly. And the guidance for the future was the cold shower.
A very cold shower, it sounds like.
Management guided the 2026 net interest margin down, way down, to a range of 4.95% to 5.05%.
Oof. That's a steep drop. We're talking about a compression of what, potentially 30 basis points from the 2025 average?
It's a big deal.
So is this just the Federal Reserve cutting rates, or is there something else going on?
It's the Fed, for sure, but there's also a very specific idiosyncratic issue here involving the Puerto Rican government. It's a mix of asset sensitivity and a big structural change with government funds.
Okay, let's tackle asset sensitivity first. We hear that term thrown around. What does it mean for OFG specifically?
Being asset sensitive just means the interest rates on their assets. So their loans, they adjust to market rates faster than the rates on their liabilities, their deposits.
So when the Fed cuts rates, their income drops faster than their expenses do.
You got it. And management is pricing in 2 more 25 basis point cuts. As those happen, the yields on their commercial loans drop almost immediately, but they can't lower what they pay depositors quite as fast.
And we saw that happening already.
We did. Loan yields fell 70 basis points just in Q4. 70, down to 7.73%. That is a sharp, sharp decline in income.
And then you layer this government money issue on top of that. Walk us through this government deposit shuffle.
So in January, this is right after the quarter closed, there was a massive movement of funds. About $500 million of Puerto Rico government deposits moved out of the bank's balance sheet and into a wealth management advisory account.
Wait, so did the money leave the bank entirely?
No, and that's the nuance. It's still in the OFG ecosystem, but it moved from being a deposit to being in an advisory account. And from a funding perspective, that difference is night and day.
How so?
When it's a deposit, the bank can use that cash to fund loans. When it moves to advisory, it's off the balance sheet. They can't lend against it anymore.
So that's $500 million of cheap funding that just evaporated. How do they replace it?
That's the rub. They have to go out and get wholesale funding, basically borrowing money from the market.
Which is more expensive?
A lot more expensive. Management noted on the call it costs about 25 to 40 basis points higher than the deposits they lost.
I see. So their cost of funds jumps up because of the government move, while their income from loans drops down because of the Fed.
Exactly. It's a pincer movement. You're getting squeezed from both ends. That is why the stock sold off. The math on the margin just got a lot harder for 2026.
And just to be clear, there was another $600 million of government funds mentioned. Is that at risk too?
That's still there, but it's all variable right now. So as rates drop, the bank pays less on it, which helps a tiny bit, but it doesn't offset losing that initial $500 million chunk. It just adds complexity. The bottom line is the easy money era for their margin is over.
It makes sense why the market got spooked. Usually, when margins compress, you look to credit quality to save the day. If the economy's good, at least people are paying their bills.
Right.
But looking at the transcript, it seems like there was some noise there, too.
Noise is the polite Wall Street word for it. Yeah. Usually credit is the boring part of the call, but this quarter had some fireworks. The provision for credit losses came in at $31.9 million.
Which is up from last quarter.
It's up $4 million from Q3.
And when you dig into it, it wasn't just a general economic thing. It was very specific.
Very specific. Management called it idiosyncratic, which is just banker speak for this is a one-off, please don't panic.
Right.
They had a single Puerto Rico telecommunications commercial loan, a $45 million loan that had to be placed on non-accrual status.
And for the listener, non-accrual just means the bank has stopped counting the interest from that loan as revenue because they're not sure they're going to get it.
Correct. And $45 million is a chunky loan for a bank this size. It required them to set aside a $5.1 million specific reserve just for that one loan.
But the company's still paying. I thought I heard that on the call.
They are. The risk officer was very careful to point this out. The checks are still clearing.
Then why downgrade it? If the cash is coming in, why take the hit?
Because the borrower's financials apparently deteriorated pretty significantly after a merger. In banking regulations, you can't just look at the cash flow, you have to look at the health of the business. So from a regulatory and accounting standpoint, OFG's hand was forced. They have to recognize the risk, even if the cash is still flowing today. It's proactive, but man, it hurts the earnings snapshot.
So that's one headache. But there was also this issue with a loan sale that confused some of the analysts.
Right. They sold a portfolio of non-performing loans, NPLs, to clean up the books. On paper, this is good. They released $17 million in reserves because they don't hold the bad loans anymore.
Oh.
But the mechanics of the sale triggered a charge-off of about $1.7 million.
So it creates this messy headline. You see charge-off spike, you see provisions rise, and even if it's technically cleaning up the books, it just looks ugly in the snapshot.
Precisely. It makes for a noisy quarter. And investors hate noise. They want clean beats. When you combine a margin squeeze with credit noise, you give the bears plenty of ammunition.
I also noticed auto loans came up in the Q&A. Delinquency there seemed to be creeping up.
It did tick up. The total delinquency rate rose to 4.18%. Now, management is claiming this is just seasonal. People spend on Christmas and skip a car payment in December.
Which happens.
It does. And they also claim new originations are all super prime, so the new stuff is good. But again, when the market is looking for a reason to sell, a 4% delinquency rate doesn't help your case.
Okay, so we've covered the margin squeeze, the government funds, the credit noise. Those are the clear reasons to sell. But management spent a lot of time on the call trying to tell a different story. They were really pushing the digital transformation narrative.
They really were. And honestly, if you strip away the immediate financial pressures, the digital story is actually pretty compelling. They highlighted their Libra and Elite accounts.
The stat that jumped out at me, and I highlighted this 3 times in my notes, was the demographic data. They said 40% of new accounts are from customers under 29 years old.
That is the golden demographic. Most regional banks would kill for that number. They struggle so hard to get young people.
You usually go to the big fintechs or the mega bank.
Exactly. For a regional island bank to be capturing 40% of its growth from the under 29 crowd, that is impressive.
And management made a point to say they aren't buying these customers with high rates either.
Correct. The Libra account is non-interest bearing. They are not paying these kids to show up. They're winning with user experience, self-service, and AI tools. They're building franchise value that doesn't depend on paying the highest rate on the street.
That's sticky money.
That is very sticky money.
It sounds great for the long term, but how does that square with the expense guidance? Because building cool tech costs money.
And that's the friction point. The 2026 expense guide is $380 million to $385 million.
Which is basically flat year over year.
It is. And in a vacuum, flat expenses are fine. But remember, revenues are under pressure from that margin squeeze. Investors wanted cuts.
They wanted to see that efficiency ratio come down.
Right. They wanted expenses to go down to protect the bottom line. But management is saying, no, we are cutting headcount. We cut 30 to 60 full-time employees using robotics and fraud automation. But we are taking every dollar we save and plowing it right back into the tech stack.
So they're promising real savings, but not until 2027 or 2028.
Exactly. They're asking investors for patience. They're saying, let us build the platform now and the profitability will come later.
Yeah.
And the market, looking at a stock trading at $42, said, we don't have patience. We want profitability today.
It's the classic tension, isn't it? Building for the next decade versus hitting the quarterly number. So let's talk about the context for an investor. Where does OFG fit into a broader strategy now?
Well, they're clearly pivoting the loan book. They're moving away from consumer debt and leaning hard into commercial. Commercial is now 43% of the total loan book. That's about $3.5 billion.
And the growth targets reflect that shift.
They do. The growth target for 2026 is low single digits overall, which sounds kind of boring. But that's because the auto and mortgage books are shrinking. The commercial book, specifically, is expected to grow 5 to 6%.
So they're betting on Puerto Rican businesses.
Big time.
And what about capital allocation? If the stock is getting hammered, are they buying the dip?
They are. They bought back $40 million in stock in Q4. That was an accelerated pace for them. And management's attitude on the call was, frankly, a bit defiant.
How so?
They explicitly stated they feel the market valuation penalizes them compared to their peers. They view their own stock as the best investment they can make right now.
So they're putting their money where their mouth is.
They are. And on the macro front, they described the Puerto Rico economy as steady. They mentioned manufacturing and pharma onshoring as tailwinds. But they did admit competition is heating up.
From who?
U.S. credit unions are getting aggressive on the island, and they said deposit competition is slowly but surely intensifying.
Okay, so to summarize the setup, we have a bank, solid balance sheet, but a compressing margin due to rates and that government fund move. Bit of credit noise, but a very strong digital growth engine with young people. And the stock drops 8%.
That's the landscape. It's a battle between the short-term margin traders and the long-term franchise builders.
Which brings us to our favorite segment of the show.
It's time.
This is not financial advice segment.
Disclaimer time. We are just two voices on a deep dive. We are not your financial advisors. Please do your own diligence. Don't sue us if you lose money. We're just reading the tea leaves here.
But if you were a hedge fund analyst pitching to your investment committee right now, based on this call, what is the outrageous but plausible trade idea?
I'm calling this one the Island Youth Arbitrage, or if you want another name, the Boomer Short.
I love it already. What's the setup?
The setup is simple. The market dumped this stock because of near-term margin compression and that messy efficiency ratio. That is short-term algorithmic thinking. It's looking at the next 2 quarters.
Okay, so what's the trade?
The trade is you go long OFG, you buy this 8% dip aggressively.
And the thesis behind it?
3 points. 1, demographic capture. They are locking in the financial operating system of the next generation of Puerto Rico. 40% of new accounts are under 29. That is sticky, non-interest-bearing money for the next 20 years. That's the holy grail of banking.
Okay, point 2.
The tech multiple. Right now, OFG trades like a regional bank, 8 or 9 times earnings. Eventually, the market is going to realize this isn't just a regional bank, it's a fintech with a banking charter. And when that realization hits, the multiple re-rates significantly higher.
And knowing you, there's a hedge.
Always a hedge. You pair this long position by shorting a basket of mainland U.S. regional banks that are heavily exposed to commercial real estate. OFG is pivoting away from CRE. The mainland banks are sitting on a time bomb of empty office buildings.
I like that. So you go long, the digital youth of Puerto Rico, and you short the empty office buildings of Middle America.
That's the trade.
You're basically betting that while Wall Street freaks out about a 20 basis point drop in E&M, OFG is quietly building a monopoly on the digital wallet of Puerto Rico. You use the buybacks as a floor because management is buying this dip too, and you just wait for that fintech premium re-rating in 2027.
Exactly. You let the algorithms panic about the efficiency ratio today, and you buy the franchise value for tomorrow.
All right, let's wrap this up. Give us the final recap for the listeners who might be eyeing that ticker symbol.
Okay. Great quarter on paper, tough quarter on the trading floor. The margin is getting squeezed by the Fed and that government deposit move. Efficiency needs to tighten up. That's the big risk. But the digital engine is absolutely roaring, and they are capturing the future customer base.
And what's the one metric to watch in Q1?
Keep a laser focus on that expense line.
Yeah.
Management guided for $380 to $385 million for the year. If they can hit the bottom of that range while still growing those commercial loans by 5%, this dip will look like an absolute gift in hindsight.
And if expenses creep up,
then the thesis breaks. That's the tell.
That's the signal to watch. Thank you all for listening to this deep dive on OFG Bancorp. Remember to subscribe to Talk Tickers for the next earnings breakdown. We'll see you on the next one.
Thanks, everyone. Keep watching the tape.